Every time a bubble bursts, we swear we've learned. We tell ourselves the worst is behind us, that markets always recover, that governments always step in. But this time, it's not a market that's breaking. It's the foundation beneath them all. What's coming in 2026 isn't a correction. It's a collapse of value itself. We've built a world on leverage, illusion, and faith. And that faith is fading. Everyone sees prices. No one sees the pressure underneath. The invisible plumbing that keeps money moving. This isn't about stocks or crypto or real estate. It's about the single market that holds the entire world together. And what happens when that market fails? Welcome to MoneyLore Insider, where finance meets mystery, and history repeats itself. When fear rises, everyone runs to safety, cash, government bonds, treasuries. But what if safety itself is the bubble? The United States owes over $35 trillion, a mountain of promises growing faster than the economy that backs it. Every dollar of that debt is someone else's so-called safe asset. Treasuries are the oxygen of the global financial system, the collateral for loans, hedge fund bets, and central bank reserves. They keep the blood of capital flowing, invisible yet vital. But if faith in U.S. debt falters, the world doesn't wobble. It stops breathing. Because every pension, every bank, every nation tied to the dollar inhales the same air. Debt used to be a tool, a bridge to build prosperity. Now, it's the engine that keeps prosperity pretending to exist. Governments borrow to fund promises. Corporations borrow to show growth. Families borrow to survive. Debt has become the oxygen of modern civilization, and the cost is tomorrow's freedom. Every economic boom was bought with credit. Every bailout delayed collapse by feeding the addiction. After 2008 and 2020, the pattern repeated. Print money, borrow more, pretend stability. But each rescue multiplies the dose. Now, the patient is the drug. There's no way back without pain. The world doesn't carry debt. The world is debt. Every financial collapse starts in the shadows. In 1929, it was margin loans. In 2008, subprime mortgages. In 2026, it could be collateral. The invisible pledges behind the system. Buried deep in global finance is a market few outside Wall Street understand. The repo market. It's where banks and funds lend to each other overnight, using treasuries as collateral. If that collateral cracks, liquidity, the blood of finance, freezes. In 2019, the repo rate exploded tenfold in one day. The Federal Reserve had to inject billions just to keep the machine alive. Most people never noticed, but inside the system, it was a fire alarm. A century ago, Wall Street found a new miracle: buy stocks on credit. For a while, it worked, until it didn't. In October 1929, as stocks fell, brokers demanded repayment, forcing investors to sell what they didn't have. The cascade began. Cheap money fed euphoria, then panic fed inflation and despair. Every era repeats this pattern, just in new disguises. In the 1920s, brokers sold dreams on paper. In the 2020s, algorithms do it in seconds. Different tickers, same trap. Too much leverage, chasing too little truth. By 2008, the world believed in a different kind of safety, the AAA rating. Mortgage bonds stamped risk-free were treated as gold, but they were built on sand. When homeowners defaulted, the illusion of safety shattered. Banks froze, liquidity vanished. Governments printed trillions to save the system, but the infection spread worldwide. The lesson wasn't learned, it was repackaged. Collateral shifted from homes to governments, from subprime to sovereign. Now the same fragility hides behind flags instead of mortgages. In March 2020, markets crashed not because risk rose, but because safety failed. Treasuries, the bedrock of global finance, suddenly had no buyers. Funds dumped everything for cash. Liquidity evaporated in days. The Federal Reserve became the world's buyer of last resort, saving the very asset that was supposed to save everyone else. That moment changed finance forever. When the risk-free asset needs a rescue, you don't have a market. You have a managed survival. Every loan, swap, and investment relies on collateral, a guarantee that keeps money flowing. And that collateral is mostly U.S. Treasuries. They are the engine oil of the financial machine. As long as they flow smoothly, the engine runs quietly. But if those bonds lose value or trust in them fades, the engine stalls. And when the engine is global finance, a stall means everything stops at once. Passive investing was sold as a revolution, a system to everyone, where money seems to move like water. But here's the truth. Most ETFs trade fast, but what they actually own doesn't. When panic hits, the wrapper stays liquid, but the assets inside don't move. It's an illusion, a financial mirage. They call it private credit, loans that don't trade, funds that never show losses. To investors, it looks safe because nothing moves. But silence can be the loudest warning. Pension funds, insurance companies, and endowments have poured billions into these steady loans, chasing returns public markets couldn't give. For years, statements looked smooth, quarter after quarter of calm numbers. Yet behind those numbers, borrowers struggle. Defaults don't show until valuations are forced to update. There are no daily prices, no flashing screens, only locked doors and unanswered calls when liquidity disappears. Downtown skylines look the same, but inside, lights are out. Empty offices whisper a quiet collapse. Each dark window hides a balance sheet where property values no longer cover the loans that built them. The pandemic rewired work. Interest rate hikes finished the job. When borrowing costs doubled, refinancing turned from routine to ruin. Banks hold billions in commercial real estate debt that no longer earns enough to pay itself. The towers still stand, but the equity inside has already vanished. For 2 decades, China powered the global boom. It bought oil, metals, machinery, and U.S. treasuries. That demand built factories, fueled shipping routes, and kept interest rates low. But today, the engine sputters. Youth unemployment climbs, exports cool, and debt within its property sector weighs heavy. When the largest consumer of raw materials slows, the whole supply chain shudders. Fewer ships sail, fewer loans move, and the world's appetite for dollars shrinks. A global system built on infinite demand doesn't know how to shrink gracefully. 2026 isn't just another year on the calendar. It's the deadline. Trillions in bonds issued during the era of zero interest rates will mature and need to be refinanced at double or triple the cost. Governments, corporations, and banks alike face the same question. Who will lend at these rates? Debt once called manageable becomes unpayable. Budgets that balanced on paper crumble in reality. The illusion of cheap money ends not with panic, but with a calendar reminder, and the bill is due. In theory, government debt always finds a buyer. In practice, those buyers are running out of room. Primary dealers, the big banks obligated to absorb new treasury supply, are reaching their limits. Their balance sheets are stuffed with bonds they can't easily sell. Each failed auction is a warning that trust in infinite demand is cracking. When governments must offer higher yields to find buyers, borrowing costs soar, and confidence slips further. The world's most liquid market can seize faster than anyone expects. In finance, everything is fine until it isn't. A tiny increase in collateral requirements can trigger mass selling. A 1% rise in haircuts sounds small, but on trillions of dollars of loans, it's a shockwave. When everyone is forced to post more collateral at once, they all sell the same assets to raise cash, and prices collapse. This isn't panic, it's math. One bad day in the repo market can freeze the flow of money worldwide. Beneath Wall Street's surface, machines run the rhythm of risk. One of their favorite plays is the basis trade, betting that bond prices and futures move together. It works most days, until volatility spikes. Then the margin calls cascade, and banks are forced to unwind massive positions. Their risk models, so-called value at risk, VAR systems, begin screaming for reductions. The irony is painful. The very models built to prevent panic are the ones that cause it. When bonds break, stocks follow. It's not earnings that move markets now, it's funding. Liquidity dries up in bonds, margin calls spread, and investors dump equities to raise cash. Crashes no longer wait for recessions, they cause them. A single shock in the world's safest market can topple every portfolio, every pension, every paycheck. The system is so interconnected that a pause in bond trading can erase years of equity wealth overnight. Every financial system runs on a fuel you can't measure: trust. Not gold, not dollars, belief. The numbers on screens mean nothing without it. When that belief dies, markets freeze. Banks stop lending because they don't trust other banks. Investors hold cash because they don't trust prices. Citizens hesitate because they don't trust leaders. Money doesn't vanish, it hides. And when money hides, economies suffocate. Every crisis in history was a crisis of confidence first. The charts and bankruptcies came later. Every collapse unfolds in 3 acts. First comes denial. This is temporary. Then panic. Why is this still happening? Finally, acceptance. It's not coming back. It's rarely the event that destroys wealth, but the delay in adapting to it. People wait for old rules to return, while the world quietly rewrites new ones. By the time most realize the game changed, the winners are already chosen. Crises always produce solutions, but solutions often look like control. Central bank digital currencies promise speed, transparency, and safety. But digital money is programmable money. One day, it's faster payments. The next day, it's restricted transactions. A tool designed to save markets could also reshape freedom. Because when every dollar is code, every purchase can be approved or denied. When money dies, value doesn't disappear, it moves. From digits to dust, from promises to things. Gold rises, Bitcoin surges, land sells overnight. Not because people hope to profit, but because they need to survive. Scarcity isn't a trend, it's memory. Every crisis reminds us to trust what can't be printed. Period. In every collapse, one divide widens between those who know and those who assume. The rich won't survive because they own more, but because they understand faster. Information and clarity become the new currency. History rewards awareness over comfort. When money fails, the best investment is education itself. 1929 taught us that leverage kills. 2008 taught us that trust kills slower. 2020 taught us that liquidity is life support. 2026 may teach us that money itself can die. Each generation faces its own reckoning with value. Those who study the rhymes of history can see the next verse before it's sung. Collapse is never the end. It's a reset. After panic comes innovation. After scarcity, discipline. The Great Depression gave us regulation. The 1970s gave us monetarism. This time, we may see a hybrid system emerge, built on digital trust but anchored by real assets and hard limits. The question is, who writes the rules for the next era? Governments or the people who finally understand money? When currencies crumble and systems fail, what remains real? Gold? Land? Data? Time? Maybe the answer is simpler: understanding. Not in systems, but in people. Because every collapse reveals who understood value before it vanished. In that sense, knowledge is the only currency that never inflates. The next crash won't be about prices, it'll be about trust. In that world, information is the new currency. If you want to see where it's all going, stay curious, stay informed, and remember, in the world of money, every fortune hides a secret, and every secret has a price.